Hey everyone, thank you for tuning in to We Built an Empire. I'm your host, Kyle Wolff. Today's guest has a pretty amazing story. He takes us from being a high school teacher to owning and operating over 2,500 doors in the multifamily and student housing sector. So without further ado, my friend, Alix Kogan.
Have you ever felt?
Are you listening? Damn. Yeah.
Mr. Alix Kogan, how are we?
I'm great, Kyle. How about yourself?
I'm doing good. I feel like it's been a lifetime since I saw you last, at least in person for sure.
Definitely been a lifetime.
How are things going? It looks like you're doing some pretty amazing stuff with your company.
Yeah, it's been good. It's been crazy. It's been busy. It feels like Durango was a lifetime ago.
Yeah. When did you leave? I think I was in Texas when you actually moved, didn't you?
Yeah, we left in 2017, so it's been a while.
Wow, that's been a lot longer than I thought. I was thinking it was like 2020, so it has been a lifetime.
So yeah, we moved in 17, and then I sold the company in 19. So
that's right. Nice.
I still had a presence. I was traveling back and forth while running my other company, so it was busy, and then since the sale, it's only gotten busier.
That's good. So what are you doing these days? I mean, I see you doing stuff on Instagram, but for the people, what are you doing?
So I run a private equity real estate shop. So we buy apartments and we buy student housing all over the country. We find off-market opportunities, and it's really no different than what I did other than the construction side, although we're doing a lot of construction. For 20 years where I was building, I was developing, and I was also buying real estate. So, I'm not sure if you knew, but, over 20 years in Durango, every year I'd buy a handful of rentals, whether it was duplexes or what I would call college rentals, which is today in our world now called student housing at a more institutional level. So really, the only difference from what I did over 20 years to what I'm doing now for the last 5 years is really just buying larger assets, larger opportunities, not with all my own capital, but we're syndicating those opportunities with friends, family offices, and even some quasi-institutional investors.
Gotcha.
Where we buy those assets and own them and operate them.
For those that may not know, can you explain syndication a little bit for me?
Yeah, so syndication, put simply, is if you think about it's just a group of investors. You've got the general partner, which we are the general partner, the GP, and then you've got limited partners. Those are the LPs, and everybody invests in the deal. Ourselves as the general partner, as well as our friends and family investors, and we own and operate. We operate it, but we own it together in an LLC. It's not a fund. It's just a single purpose entity LLC to own and invest in that opportunity. So it's really just kind of think about it as kind of a crowdfunding opportunity to raise funds and buy real estate.
Nice. How many doors do you guys control right now, if you don't mind me asking?
Yeah, we have about 2,500 doors, about 1,500 beds in student housing. So it's about a $250 million portfolio that we own and manage.
So it's just a small portfolio.
Well, I mean, I think we're small. Most of the guys we run in the same circles, they've got $1 billion under management. So we still feel very, very small. I mean, we're a small boutique firm. There's 5-6 guys here, and I touch and feel every deal, every investor. So we're small.
Yeah, that's still just amazing. That's God. So I do want to take it back. I know we've got just a little bit of time here with you today, Alix. So I do want to go back real quick to the time you spent in Durango, because you're not originally from Durango, are you?
No.
Okay.
No, I'm from Chicago, and I was the black sheep that ventured out west in '98 and landed in Durango.
Yeah, just happened on Durango, or like ski trip, or what was it?
There's a little backstory there. So I had this moment where I was going to save the world and teach high school. So I actually moved to Chinle, Arizona, taught high school on the Navajo reservation, And on the weekends, my ex-wife and I used to go up to Durango and fell in love with the area. And after a year and a half of teaching, I was done and decided to go move to Durango and follow what my family did. My family are builder developers, so I went to work for a builder in Durango for a year, and then started my own shop, as you know, and the rest was history.
Sure. Absolutely. That's a big swing going from teaching. I don't know if I knew that you were a teacher. Maybe I'd heard something about that, but that seems like a drastic leap, you know?
That's when I was young and dumb.
So when you started your company, for those that may not know, but Kogan Builders, right? Was the name of it? KBI?
Yep.
So when you started it, did you have a team with you? Like, did you have, or was it just you out there swinging a hammer? Or what did that look like?
Yeah, so it literally was myself and one employee. So I went out on my own. I was a superintendent, project manager for another builder, started my own company, grabbed a guy that I knew, and I remember getting my first contract, which was to build a $1 million+ log home, which is, in 99, I think that was, or 2000. It was just a massive deal. And there it was, just myself and another guy and our tool bags on. And, and then from there, it just went on and the business kept doubling almost every 6 months. And before you know it, I think fast forward a few years ahead of that, had an office downtown and had, a full team. And sadly, those tool bags that I had since day one, I don't think they ever got picked up after the first year. So
that's not a bad deal.
I quickly retired, learned that, carpentry is something I could do, but it's not my strong suit.
Sure. That's awesome. Yeah. I mean, you grew it into arguably, one of the most prolific custom home builders here in town. So my hat's off to you. So I was talking to a gentleman the other day, and I really want to pick your brain on this same concept because it blows me away. My wife and I've done, a tiny amount of buying condos or buying single family and doing the rental thing. But to go from that situation, even though your private portfolio here in Durango and kind of the surrounding areas, to go from that single family sort of multifamily, college type of a management scenario, whether you were self-managing or sending it out to an agency to manage for you. What does that transition look like? And, how did you get into multifamily, this sector of business? Cause it seems like it's such a gigantic leap. I know that, you're just tacking on more rooms, right? I understand that, but I find it hard to believe that they're even on the same highway.
Yeah, it's so, without getting into all the weeds, I'll tell you that it was a pretty smooth transition. I got to the point where we were self-managing all of my portfolio. Then I had interests in Chicago. There was a span of 5 years. I was flying back and forth between Durango and Chicago 1 week a month, and I was scaling another business that my brother and I were partners in Chicago. And it got to be where there was almost another company within the company. And my CFO of Kogan Builders managed that portfolio. And I realized by accident, really, that I could invest all over the country and not have to manage, that I can hire best-in-class third-party property managers. And I did that by investing passively as an LP myself. So I forget the year. It was probably 2012, maybe 2013, that through my relationships in Chicago, I found an opportunity to invest in what we just discussed as a syndication, an apartment syndication. And then fast forward, I think the following year, we had an opportunity to buy a really nice apartment community in Wisconsin. And that my brother and I and investors were going to buy it. And that deal, there was some infighting between the partners. And I just said, life's too short. I didn't want to move forward. So I kind of put that all on the back burner, kept investing in apartments as an LP, as well as investing in my apartments in Durango and Chicago. And started talking to one of the sponsors, and it was a gradual process. The sponsor asked me to help him raise some equity. So through my friends and family, brought some dollars to the table, helped him raise a little bit more equity. Before you know it, I said, you know what, this is something I can do. It's not rocket science. And in fact, it's easier with more scale. If you have a 100-unit apartment complex, it's actually easier to find good property managers because it's a large enough of an engagement versus, if I had 6 single-family homes, to find a good property manager at a competitive rate is challenging.
Sure.
And that was it. That's how I pivoted. And I had more motivation in 2017 when I had a kid, got married, had our son, and we decided to raise our kid back home near family. So I moved back to Chicago, and that's what really was the turning point where I just started unloading my Colorado portfolio and buying these larger deals. And I found that it was easier to do with having third-party management than trying to manage it all ourselves.
Gotcha. So you said you invested those first couple of rounds as a passive or an LP. Did you prefer that over, other means of investment as far as like, was it, I've heard both topics of, it's like, I want to be the general partner. I want to manage it. And I think that sometimes you get that feeling of someone doesn't really want to let go of the reins. They don't really want to write a $50,000 check and hopefully somebody manages it properly. I mean, was it ease of investment for you, or was it trying to learn the syndication game, so to speak?
It was both. It was easy because I had a lot of confidence in the sponsor. I knew them. There's personal relationships. I had a great track record. So it was easy for me. And it's the investment vehicle that I love the most. I mean, real estate is what I've built my wealth in and what I know the most. So that part was easy. When I realized it was only a matter of time that I was going to sell Kogan Builders, and I'm 53 years old now, I knew that I wasn't going to retire. I didn't want to. I mean, I could have, but I didn't want to. I knew that I wanted to work probably until I'm 70. And so I knew after selling Kogan Builders, what's next, and continuing in real estate was a natural progression. So I wanted to be a general partner. I did not want to be a limited partner. I knew that I could build another company, and that's what I started doing.
Nice. That's definitely a good way.
But it was a really good way to do it initially as an LP, because you get to look under the hood. You get to see how apartment complexes are operated, what works, what doesn't work, and make some money along the way as a limited partner. It was a really good way to do it.
Yeah. So what do you guys, so like my wife and I have sat in on a couple of capital calls, from a passive investment stance, and a couple were an immediate no-go. This is not a good fit for us. Doesn't even matter the dollar. It's like, whether like or trust that person, this is not a, X. But then we've sat in on a couple that were really great. And then we got to like round 2, round 3, make a private phone call. And it's like, hey, I need a little bit of explanation. And it's at least the people that we've kind of aligned ourselves on some of these things. It's such an open book, and it's absolutely transparent on everything. So do you guys practice something kind of similar, or do you have a group of people that you pull, a mass majority of your funds from, or do you kind of, I know it's not crowdsourcing. I know there's legalities to it and how you can do that, but
yeah, we can actually raise equity openly because we do what's called a 506C, which is accredited investors only. On occasion, we'll do what's called a 506B, which you don't have to be accredited. But with a 506C, we can advertise, we can raise equity openly.
Gotcha.
So in terms of, it's fully, everything, we're an open book. We have to be. In terms of, what's, I think you're probably trying to ask me, like, what is kind of a no-go from an LP perspective versus something that's attractive. And I think one of the biggest mistakes that LP investors make is they look at a glossy brochure, offering and say, wow, these are 20% returns. And they focus on the returns. Well, the biggest mistake you can make is just focusing on the return and not what's driving that return, which is the underwriting. What are the assumptions?
Sure.
And I would say that's the biggest thing that you need to focus on. Is it, for example, is it 6-7% rent growth per year that someone is assuming they're going to achieve? Or is it something more modest? Is it 2 to 3%? There's all kinds of underwriting assumptions in terms of your debt, your rent growth, your taxes, your insurance, your OPEX. That's where a deal is made or not.
Gotcha. So, the one thing that I thought was really neat, I was kind of just doing a little bit of research, but was the, the student housing. So I know that I mean, every syndication book podcast in the world, like, there's different facets. There's multifamily, there's, long-term rentals as far as storage units, but I haven't at least seen a whole lot of, maybe it's not an advertised type of thing or talked about, but the student housing thing sort of stuck out to me. And I was like, that's a really, I mean, it's highly needed and desired and sought after, but that was something that I found really cool that you got yourself into. Can you kind of give me a little backstory on that?
Well, I mean, it all started in Durango when I was renting houses, duplexes, anything and everything to college students. And I realized that they're a pretty good renter, as long as they're not partying and trashing the place. And I remember even in Durango, I'd get parental guarantees. I get a cosigner.
Gotcha.
So, if you want to trash this place, mom and dad's going to end up paying for it. So they're going to be a little bit more careful what they do. Fast forward, I ended up meeting a guy here in Chicago who's now a partner of mine on deals, and also our third-party property manager was a guy who's been in student housing for 25 years. And I started learning more and more about the space and realized there's two things that I like and I don't like. It's an operational play, which is more challenging because you have to really know what you're doing to operate that asset and put your mind in the mind of an 18, 19-year-old college student. You just have to know how they think. You have to know what they want, what they don't want. So there was a higher barrier to entry, and that's what I liked, because not every conventional multifamily guy is going to make the transition into student housing. So I like that. I don't, the less competition you have, the better. Anyways, long story short, fast forward, I aligned myself with my friend Jerry. We partnered on deals and started buying student housing. Student housing is interesting that it's counter-cyclical. If you look at 2008-9, those are some of the best years for student housing, and that's because if there's a recessionary period, kids tend to stay in school longer, go back to school. So there's actually a greater demand. The other thing which was really interesting when COVID hit, obviously we were all concerned about our assets, what's going to happen, are kids going to go home? Are they not going to home? Are they going to pay rent? Are they not going to pay rent? Well, what happened was they largely continued to pay rent. They largely stayed on campus because they didn't want to go home to mom and dad's house and sit in the basement, going to school virtually. They still want to be on campus with their friends. And then the natural sensitivity from COVID also made kids more sensitive to being in a dorm, sharing a bathroom or sharing a bedroom. So now all of a sudden kids and parents wanted their own rooms, their own bathroom, which created a higher demand for what we do, which is off-campus private housing, basically an apartment complex for students. So those are all the reasons we love the space. Higher barrier to entry, really strong asset class. In the last couple of years, major institutional capital has been pouring into the space because they're good returns. It's risk adjusted, parental guarantees. So it's just another, multifamily sort of niche that we love, and our student housing portfolio is just doing incredibly well.
Is it something is it contracted with universities or the colleges, or is it completely private?
No. So well, that's a good question. Some apartments actually do what's called a master lease, where the university will lease your entire apartment complex, or at least a couple of floors, and then they'll basically release those beds to their freshmen. We don't do that. We are strictly private housing that's direct to a student or their parents.
That's pretty interesting. So no subsidies or anything from the schools.
There's different marketing, but it's largely run, the same way as a conventional multifamily, but understanding that, kids do it differently. They rent by the bed. They don't rent by the bedroom. So you have a 4-bedroom apartment. You actually have 4 different leases, 4 different residents. They all share the common space, of course, but you're actually signing 4 different leases. You're involved in all the roommate, matching and roommate conflicts, of course.
Sure.
Yeah. You're leasing up, obviously, in the fall, and you've got a short window lease up. So a lot of these dynamics that are different than conventional scare other people away.
How does that work? How does that work with the turn rate on as far as, so it is maybe each semester, or how
Every
does a lease
year,
look?
yeah, we lease for a year, 12
Okay.
month leases.
Gotcha.
And every year, you'll have renewals if they're going to stay, in school for another year or two. Of course, we're going to try to get them to renew. So that's sort of the bad thing of student housing. It's higher turnover, but that also is a good thing because as you turn over and sign new leases, you have an opportunity to raise rents.
Gotcha.
If you're renewing, typically you're not getting as much on a renewal as you are on a fresh lease.
So are you like on the student housing specifically, are you looking for deferred buildings to where you can do a standard, like, where you're trying to force the appreciation, or are you buying a class A asset that you can get a guaranteed higher end rate day one?
We'll do both. So, some sort of value add play. One obvious value add play is a CapEx, so some sort of renovation that's bringing them, from current condition to market, raising rents, forcing that appreciation. But largely it's actually both. It's a management play as well as a CapEx value add. So we're typically finding both opportunities.
Gotcha. So in your other portfolios, just as far as your multifamily, are you guys looking, what class do you typically look at? Because I've seen just online some of the stuff that's clearly class A, or maybe even if there's a higher caliber. But I mean, are you kind of playing the gamut there, or do you focus on class A?
Our biggest driver is risk-adjusted return. So our investors are looking for that mid-teen IRR over a 5-year hold. So you take 100,000, 5 years. 5 years later, you're going to basically double your money to 200,000. So how do we get there is the question. So oftentimes it's that forced appreciation with a value-add project. On occasion, we'll find an interesting management play with a Class A asset. So typically Class A, newer vintage, prime locations, they're less return, but they're less risk. But we found, as you can see from our portfolio, some management plays where we're newer assets, we're not being managed well. So we came in there. In one case, we've got a great deal in Des Moines, Iowa, that the developer built it and they leased a bunch of units all at one time. So you had what we call clustered leases that were renewing at the same time. So they found themselves in a pattern of constantly doing incentives and promotions because they got everybody every year moving out at the same time. So we came in there, we kind of evened out the leases. So all the new leases that we signed, it wasn't necessarily for 12 months. It might be 8 months, 9 months, 14 months. So we spread the leases out. We evened out our operations. We didn't have to have concessions. And the assets operating beautifully and getting us the same returns we model for the value add business plan without doing any value add. It's just all operational.
That's interesting. Yeah, that was listening to something the other day, and this person was just speaking on they're going after either high end Class B or Class A product, waiting. They're anticipating the 5-year wait or the hold, thinking that they would be able to sell at a higher rate of return. Even in that short span, because it is a newer unit and it would be less cost on the front end for somebody to buy. Like, let's say they buy a D or a C today, invested that money today. So they're buying higher. And I just thought it was an interesting concept. I was like, I mean, I would have to look at the math, I guess, if you take, a C class project and invest into it and then do the whole, just like look at them side by side, like which is one is going to yield more. So it was just an interesting concept, but I was looking at your portfolio and I was like, I mean, it's all over the place. I mean, it's not all over the place. I shouldn't say that, but you clearly have Class A and some other stuff that's maybe a Class B.
We do. We've bought A, B, and C class assets. It's all about the opportunity. That's why I think a lot of guys look at stuff very generically. They look at a deal and they underwrite that deal the same way, whether it's in Des Moines, Iowa, or Gainesville, Florida, wherever. You can't. You have to look at all the micro demographics within that market, and if you can find a risk-adjusted return, that's what we do. And sometimes it's in a C, sometimes it's in any property.
Gotcha. From a passive investment standpoint, if you're looking at a deal, if it's for yourself, and maybe your risk tolerances might be a little higher than others, but if they look at a deal and they see underwriting feels solid to them, they've worked it into their model, maybe they're new to this and they're looking at something, what's a standard, what could they expect on, a cash on cash type deal? And what do you have any advice for something that's like, you need to walk away? Like what's a major red flag for you? Like if you're looking at a deal and it's just you, your own money, your capital, your 100 grand or 50 grand, and you see something and it looks good, the underwriting seems good, but something just doesn't feel right, or if they're projecting too high of a return, have you kind of sort of developed what you think is your like get out?
Yeah, and it goes back to my previous comment about aggressive underwriting.
Yeah.
If somebody is underwriting too aggressively for the market, that's a red flag. I wouldn't invest in that deal. And by the way, I'm a very conservative investor, so my risk tolerance is not high. We try to get singles, doubles, a triple here and there, but we're not trying to get home runs because the risk is higher. And I've been kind of a steady Eddie investor for 25 years now, and I'm more than comfortable doing that. I don't need to roll it all on one deal for an outsized return. So as an LP investor, you got to look at, I always bet on the jockey first. That's what I did. So bet on the sponsor. Is the sponsor credible? Have they had success in their career? Have they been in real estate? You're seeing a lot of new guys who's like an IT guy. Nothing against IT guys, but a guy who's in IT saying, I want to buy real estate tomorrow, right? And then he's starting to raise capital. Well, I would think twice. Have you demonstrated success? Do you understand real estate? Do you understand finance? So, I would certainly be looking at the track record of the sponsor. And then again, then goes back to the underwriting. You can validate people's assumptions by doing research. Find out what the historical rent growth has been. Find out what it's projected to be. These are all just kind of published data points.
Sure.
But at least they will say, something seems out of whack. And then ask a lot of questions. Talk to the sponsor and have them justify you how they're going to execute that business plan. A lot of it is common sense, believe it or not. You can appreciate this. I'm in construction. I've been in construction for many, many years. I've seen sponsors say, I'm going to buy a 100-unit apartment building, and their business plan is to renovate 100 units in the first year. So all the units in the first year. And their vacancy is like 5%. So I say, how is that possible? How are you going to do that?
Sure.
They haven't thought through of what that would take, right? So again, another red flag. So you just have to use good common sense, or have a trusted advisor. I get my friends call me all the time, say, hey, there's a self-storage deal I want to invest in. Will you look at it? Sure, more than happy to. Here's a list of questions. Ask the sponsor.
Sure, absolutely. That's kind of been one of the things, just as we're sort of, brand new into this, and syndication a year ago was introduced to me, and I was like, what is, you mean we can all just pull together our money and buy it? So I've got a lot of really great people that I again, know, like, and trust, but maybe they've got 5 or 6 or 7 or 10 deals in that span that have come together. But it's a little scary to me that even these folks that in my opinion, are brilliant minded, none of these have gone full cycle. And it's
right.
A little scary. It's like, it's great returns. I get it. The money's there, the investment, you're promising this and we're hoping that it goes this direction. But it's like, I'm more cautious to invest with somebody that hasn't taken one all the way back around. What is it? Have you proven your worth? And so it's, as this syndication world seemed to, at least over COVID, and in my opinion, just blew up. You've got so many people that are being introduced to this, and it just seems like it's the biggest frenzy. So it's like, people are buying things way at a ridiculously low cap rate, which, cap rate is cap rate, but, it's just like they want to get into the market so bad that they're willing to just be heavy on the risk side. And it's like, even if it says it's going to make money, it's like, God, I really, unfortunately, it's like, I almost need to talk to some of you guys 5 years from now when you sell this asset, and I know that there is a risk to every investment, but for me, being a little bit more conservative on the true investment side, it's kind of, it's a little, I'm extra cautious to it, I would say.
Yeah. Well, you should be 100%. You want to see that people know what they're doing and they've gone full cycle and they know how to buy something, add value, execute the business plan, and then sell it.
Yeah. That's awesome. So for, anybody looking to get into this, let's just say from a passive standpoint, investment, do you recommend anything that, that's tried and true for you as far as, and there's a 1,000 things published out there. There's 1,000 podcasts, but the thing that worked the best for you, do you have any recommendations for people that, they could go grab this book, or they could, start to research this, that, or the other that would kind of give them a real fundamental understanding of this?
There's a ton of resources out there, Bigger Pockets. There's, a ton of books. There's a ton of podcasts where you can read and learn. I think, one of the best things to be able to kind of sort of sift through everything that's out there in terms of investment is get a referral. So if you know someone who's invested with a sponsor and they had a great experience, great, talk to the sponsor. That's the way I did it. Personal relationships are everything. The last thing you want to do is see some ad on Facebook and say, "Oh, that looks good."
They paid a ton for marketing. Let's go ahead and buy in.
Right.
Yeah. Well, that's good, Alex. Well, thank you so much for being on. I really appreciate you. Sorry we couldn't get it scheduled last week. I'm actually glad because I was so sick last week. I was rescheduling a bunch, and then you hit me up. It was like, oh, thank God. So I really appreciate you.
I'm glad that worked out. Yeah, it was great. Great to be on. Great to reconnect with you.
Are you listening?